Hello, fellow Rebel Capitalists. Hope you're well. Holy cow. The CPI numbers out today. The market was expecting 8.8%, a rise from 8.6. We got 9.1. Whoo, boy. I tell you what, it is getting interesting to say the least. I think that Lenin quote, I always say that, man, it just every single time it seems every morning I wake up, it just, that's the first thing I think about. That decades go by where nothing happens and weeks go by where decades happen. And we're seeing decades happen right in front of our eyes. That is for sure. It's a crazy, fascinating time to be alive. That's for sure. But let's get over to the CNBC homepage, see what's going on with the CPI. I'll give you my thoughts. We'll see how it's affecting asset prices. Is gold up? Is gold down? What's the 10-year doing? What's the front end of the curve doing? You want to tune in for this. I could guarantee you that. Let's get over to the page. And let me refresh. So as you would expect, Dow futures are down 300. This is because now with a higher inflation print, they're expecting the Fed to potentially raise rates by 100 basis points, 1% at the end of July. I think the market previous to this was expecting about 75 basis points. I think the majority of the, excuse me, of the people polled, the experts, quote unquote, still expect a 75% base or 75 point basis hike. And I was just listening to a live stream on Twitter with my good buddy Joseph Wang, and he was saying that he still expects 75 basis points because 100 he just thinks would be a little bit too much for the market to take. And he says the Fed wants an orderly decline in the market. They don't want a disorderly. So he's still betting on a 75 basis point hike, but the probabilities for a 1% hike increase dramatically, obviously with a 9.1 CPI print. And that's why you most likely see the Dow futures down. Now, with a CPI print that is way higher than expected, and I know it doesn't seem like a lot, but the difference between 8.8 and 9.1, I think even just subconsciously to get over 9 is just like a big deal. But you would expect the bond market or yields to go up, right? I mean, inflation is running hot, especially the 10-year and the 30-year. So what's the 10-year doing? Barely moved. Now, I don't know. Let's see. This might be, I'm not sure how treasuries trade. I'm a macro guy. I don't get into the nitty gritty and the weeds, that's for sure. But it might not trade on, this might be pre-market stuff. We'll have to see at 9:30 Eastern.
It's pre-market, but it says at the bottom that was shown at last since 9:21 a.m. Eastern.
Yeah, but my point was that it's pre-market. So once it starts trading, I believe at 9:30, just normally, you could see some pretty extreme fluctuations there. But as to Josh's point, what's that? Okay. Anyway, so what we're seeing right now is, at least in pre-market, is the 10-year treasury yield not move much at all. So how is this possible that we can get a CPI print that vastly exceeds expectations and the 10-year just shrugs it off? Whatever. No big deal. But look at what's happening to the 1 year and the 2 year. So just make sure I refresh here. So the 1 year at 3.23, we've got a 20 basis point inversion between the 1 year and the 10-year. Wow. So if you're new to the channel, the 1 year and the 2 year, but especially the 1 year, is going to be highly impacted by expectations for Fed rate hikes, where the long end is more about future inflation expectations and growth. And so the long end is basically saying, hey, we don't care about the 9.1% print. You're still getting disinflation and you're still getting a recession. And in fact, the long end could be going, okay, well, you can go the front end, you go ahead and raise all you want. But the more you raise and the more the expectations of the Fed increasing rates goes up, the higher the probability that we get a recession. So you go nuts, short end of the curve. Woohoo. We're just going to hang out over here at the long end around 3%. And in fact, if you go up too high, we're going to go down to 2.9% because the higher you go, the better the odds are that we get a recession, that the Fed breaks something. I think that's maybe what's going on with the bond market right now. Because what else would explain? Well, obviously we know why the 1 year goes to shoots up to 3.23%. And of course, the main reason why the 1 year shot up to 3.23% is because I bought 1 year treasuries on Friday. So you know that as soon as George Gammon buys, it has to go the complete opposite direction. So I'm losing money on that. That's great. If you guys haven't followed that story, what I'm doing for Rebel Capitalist Pro is I set up an IB account, Interactive Brokers, with $100,000 of my own money. And I wanted to just set up a portfolio because so many people ask me, George, what are you doing with your own money? How are you investing? How should we do this? How should we do this? And I always say, well, it's a 10-80-10 portfolio, but I never really show people what's going on. So I thought it would be beneficial to set up a portfolio and just really open up the kimono and say, okay, here's 100,000, and here is how I'm going to allocate the capital step by step. And I might not do anything. I might keep it all in cash, or I might do this. Well, I'm going to get 10% in gold. And so we did a live stream, Josh and I, the other day on Friday, buying the $50,000 in treasuries because I got that 100,000. So 10-80-10 would mean I've got 80,000 I'm going to allocate to cash flowing assets. So things that pay me to own them. And then another 10% gold, another 10% speculative assets. So with the 80%, I'm really looking forward to buying commodity producers at a lower price if we go into a recession. So I wanted to keep as much dry powder as possible there, but I figured it'd be a good idea to go into 1 year treasuries because 12 months from now, I figure if commodities are a lot lower to a point where I'd want to buy them, most likely rates would be a lot lower as well because we would be in a recession, or we would most likely be in a recession, and therefore you're getting a capital gain on your dry powder. And worst case scenario, you just let if commodity prices don't come down to a level where you're wanting to pull the trigger, then your 1 year treasuries, you let them mature, you take the principal, you take your basically 3% and go home. But obviously, if I were to sell right now, which I'm not going to, I would take a loss. So anyway, if you want to follow my journey, and if you want to kind of look over my shoulder and find out what I'm doing with that $100,000 portfolio, you got to check out Rebel Capitalist Pro. It's only $1 for a week. You can't beat the risk reward. It's at georgegammon.com/pro. But let's get back to this here. So I think hopefully you guys get my thoughts about the bond market and what we're seeing with the action and how different it is at the short end and the long end of the curve, and what it's telling us about the chances that we get a recession, and then what the chances are that the Fed continues to hike and maybe hike faster and then break something faster. So Let's check out oil. Inflation skyrockets higher. You would expect oil to do the same. Oil down. Oh, but wait, there is more. Gold. You would expect it to explode higher, go parabolic to infinity and beyond. 9.1% inflation. This is the 1970s. Gold down. Copper down. Silver down. Platinum, palladium, all down. Guys, I think it's easy to get super kind of riled up. I know those were my initial emotions when I saw the 9.1%. But what everything else is telling me, obviously, who am I? I'm some hack on YouTube. But what the market, the other assets, the other markets are screaming is that, yes, the Fed is going to raise faster. And that just means that we're going to get a recession sooner than later. That just means we're going to get the recession faster. Faster the Fed hikes, faster we get a recession. I think that's the main takeaway for the video right now. So let's go ahead and read this article, see what CNBC is saying. Oh, and by the way, I read that Jim Cramer said that yesterday or today is going to mark the low in the stock market. So make sure you write that down. Make sure that you go long today for sure, because Jim Cramer said so. All right, let's get back. Enough of the jokes and the clown boy, Jim Cramer. So what's CNBC saying about this? Inflation rose 9.1%. Oh, and this is a good point. I want to be very careful with my words here, because I think it's very important, this concept, which I will try to articulate to the best of my ability, and I'll probably butcher it. Over two things. Number one, over the past 2 or 3 weeks in the macro space, you've heard a lot of people talking about disinflation, me being one of them. Now, to be fair to me, and if you watch my video last night that was talking about the bullwhip effect and disinflation, I said that I expect the CPI print to come down in Q3 or Q4 of this year from however high it is, right? So we're obviously not at Q3 or Q4 yet. But I did notice kind of everybody talking about disinflation. And I think it makes sense that the CPI print we get today, although I would not have expected it, surprises on the upside. Why? Because everyone is talking about disinflation. So sure enough, that CPI print is going to be higher than expected. The market's always going to make the most amount of people look foolish. Now, I think, and we'll have to see how this plays out over the next month. Like I said, I was just listening to that live stream on Twitter with a lot of super smart guys, and everybody's talking about inflation now. And I think next month we could see the opposite, where everyone's talking about, oh my gosh, how high is it going to go? Is it going to go over 10%? Is it going to go over 12%? What's the next print going to be? If it goes over 10%, what's the Fed going to do? Are they going to raise by, blah, 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 blah. And I think that because this exceeded expectations and now we're over 9%, again, that subconscious line in the sand, that it's not just an 8 handle, it's a 9 handle now. Everyone's going to be talking about inflation going, as if it can only go higher. And then, of course, everyone's on that side of the boat. And then next month we get a lower CPI print. Again, the market is always going to make the maximum amount of people look as foolish as possible. That's idea number one. And this is something that I need to be more cognizant of, because all these people that I listen to and that I've got a tremendous amount of respect for and that are way smarter than I am, they talk about disinflation. And this is an idea that I have had. And so you kind of like it reinforces your beliefs. Therefore, you get this, kind of, what do they call that? They call it a, not a confirmation bias, but you kind of get in this echo chamber. That's the word I was looking for. So you get this confirmation bias that feels good. And I think as human beings and investors, human beings are hardwired to do the opposite of what you should do in investing. And I think one of the things that makes us feel good is if we have a particular view, say gold is going higher or gold is going lower or Bitcoin's going down, whatever it is, that we seek out people that are saying the same thing because it makes us feel good. And I'm in that, and the reason I think this is true, because I've noticed it in my own life. And I think if I do it, probably most people fall victim to this mistake as well. And so just reflecting back on the last 3 weeks and what happened today, I think for me, that's the biggest lesson, that whenever I see people agreeing with my view, number one, look for a different view. And number two, in the short run, you're probably wrong. Now, second point I wanted to make here is the market and especially the average Joe and Jane retailer, they're going to, this makes it seem 9.1% inflation. So it seems like as of today, we have 9.1% trailing 12 months. No. This is the June number, guys. This is the June number. This is looking in the rear view mirror. This is not looking in the windshield or even a number that would reflect where we are today, July 13th or 12 to 13th, something like that, middle of July. So this is looking in the rear view mirror. So again, maybe everyone gets super, super excited about inflation and they expect it just to go to 10%, 11, 12 to infinity and beyond, Buzz Lightyear. But they lose sight of the fact that this was a June number, as were the jobs data. That's, I don't have it right in front of me, but I believe that was a June number as well. And when I started to see all of these indicators, market indicators screaming, I mean, they've been doing it for a long time, but they really started doing it, not in June, but in July. So this could be the market's way of kind of pulling the rug out from everybody that may now think that we just have to have inflation going straight up. And then maybe I'm wrong. Maybe inflation continues to go up for the next, in a straight line for the next 3, 4, 5 months. I can tell you at some point in time, it's going to come down from whatever. Now, maybe it comes down from 12. I don't know. But it never, ever, 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 and it never will go up in a straight line for, call it 3 years in a row or something like that. It's always going to have a big, big pullback. Look at the 1940s. Look at even the 1970s had big pullbacks. So, but when is that pullback going to happen? Like I said, I'm expecting Q3 or Q4, but maybe it doesn't happen for another 6 quarters. Who knows? Who knows? That's why this game of macroeconomics is so much fun, because just when you think you got it figured out, boom, you get the right hook from Tyson. And it's always changing. It is truly what they call it, the sixth, a sixth dimensional chess game, or whatever it's called, Rubik's Cube. So anyway, let's get into the article here. I'm just ranting on about the inflation views and everyone being on one side of the boat and how the market's going to make everyone look like a dumbass. Okay, so consumer prices up 9%, market expecting 8.8, like we said. That marked another month, excuse me, the fastest pace of inflation going back to December 1981. Excluding volatile food and energy, so-called core increased 5.9. So that's a big deal for the Fed, because that's really what they look for, or that's the main number they look at. On a monthly basis, CPI rose 1.3% compared to an estimate of 1.1. Taken together, the numbers seem to counter the narrative that inflation may be peaking. Energy prices surged 7.5 in the month and were up 41% on a 12-month basis. Yeah, but let's just exclude that from the CPI, because it really doesn't impact the average Joe and Jane. I always love that. Let's measure prices, but exclude food and energy, the two main thing that people need. Rental costs up 0.8%, largest monthly increase since April 1986. Okay, so here's some more nuance for you. The biggest component of the CPI basket is what? You guys know this. Owner's equivalent rents. Right off the top of my head, I think it's 30, maybe 33%, maybe even higher. And remember when they made the adjustment to the CPI, the measurement, back in January of this year? What did they do? They increased the weighting for owner's equivalent rent. Now, just because rental costs, and I don't know where they're getting rental costs. Is this via the Fed? Is this from realtor.com? Is this from Zillow? I don't know where they're getting this number, but we'll assume it's from the Fed. So the Fed is saying that owners equivalent rents went up 0.8%, not rental costs, because those are two completely separate things. The Fed likes you, or wants you to believe, that they're one and the same, but it's a completely bogus number that they kind of pull out of thin air. So my point is, if rental costs or owner's equivalent rent went up by 0.8, and that was higher than expected, the largest monthly increase since April 1986, this would explain why the overall CPI overshot to such a degree, because this is such a large component of the overall CPI basket. Much of inflation rise came from gas prices, 11%. Electricity costs rose 1% over the month, or 1.7, 13.7% respectively. Just think what they're doing in Europe. Medical care increased 0.7 on the month. Airfares were one of the few things declining. Meat, poultry, fish, eggs category fell 0.4%. So food slightly coming down. White House officials have blamed uptick in prices on Russia. Oh, we got to get to a certain point where people just laugh at, not just people like rebel capitalists who understand economics and what's causing inflation, but even the normies out there. Even the average Joe and Jay, even Moody the millennial, at a certain point has to look at this and just laugh and say, okay, feed me another line of BS media or administration. I'm not buying this anymore. Oh, I'm sorry. Here we go. And it's not just Russia. The administration, I'm reading from the article now, the administration and leading Democrats have also blamed what they call greedy corporations for using the pandemic as an excuse to raise prices. Corporate profits, however, have increased just 1.3% in aggregate. Jeez. So it's Putin's fault and it's greedy corporations. If I was the average American, I would be insulted. Seriously. Like, we always hear the snowflakes and everything say how everything is offensive. Oh, you're offending me. You're offending me. My pronouns aren't blah, 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 blah. You're offending me because you're not using my preferred pronouns. Whoa, snowflake, But this does offend me. It takes a lot to offend me. I'm almost unoffendable. But this does it's offending my intelligence, really. And I think the average Joe and Jane should feel the same way when they come out and say these stupid things like, oh, it's all about Russia, it's all about greedy corporations. It's really just them in an indirect way announcing to the general public they think you're stupid. I mean, if if a politician got me in a room and said, well, obviously inflation is because of Putin and greedy corporations, I would be like, what do you think? You actually think I'm stupid enough to buy that? So this is, and so my point is, what surprises me is that more and more people, especially the media, don't call them out on this just complete BS. And how many people just buy this hook, line, and sinker without even questioning it? I mean, you could say this to a third grader and they'd be skeptical. How is it that adults just don't even question it? All they do is they just like open up their brain and just go to the administration and say, yep, pour whatever you want right into the old noggin and I'll buy it. Unbelievable. All right, guys, that's what's going on here. Again, main takeaways. I think the bond market and asset prices are saying the faster or the higher the CPI, the faster the Fed raises rates, the faster we go into a recession, and the faster the Fed reverses course. I think that's the bottom line from what the market is telling us as of right now. Enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. And whenever it seems like everyone is agreeing with you, proceed with caution. We'll see you on the next video.